Good morning, and thank you all for joining us today for our forum titled Accelerators, What Do We Know About Their Role in Supporting Entrepreneurship? My name is Anya Pichenina, and I am a program officer focusing on research translation work at the Kauffman Foundation. To frame today's conversation, I would like to share some background on accelerators from our recent issue brief. So what are the accelerators? Accelerators are cohort-based programs that provide access to supportive services like mentorship and trainings. Accelerator programs run for a fixed term, usually several months, after which participating startups graduate. Graduation events are often demo days where startups pitch to selected groups of investors, media, and other stakeholders. The structure and types of program offerings in an accelerator can vary. Some examples of design choices in accelerator program offerings include duration of the program, amount of funding provided, whether equity is taken and in what amount, cohort size, mentoring structure, and activities, and others. As accelerators are a fairly recent development, we are still in the process of understanding whether and how accelerators affect startups' abilities to raise funds and reach key milestones, and their effects on entrepreneurs and the economy broadly. Today, we have invited several panelists to share what they are learning about accelerator programs, what is most valuable for entrepreneurs, who benefits from accelerator participation, and short and long-term outcomes of accelerator participation. Our panelists include researchers, accelerator managers, and accelerator graduates. We have two exciting panels. In our first panel, we will hear a presentation by the Global Accelerator Learning Initiative, or Galley. Galley recently issued a report covering 5 years of evidence from the initiative and will share the insights from this work with us today. In our second panel, we will hear from researchers studying entrepreneurs, individuals running on accelerator programs, and entrepreneurs who have participated in accelerators. After each panel, we will have a moderated Q&A, and I would encourage you to send in your questions to us in the Q&A box throughout the presentations. Our speakers today come from diverse backgrounds in research and startup sector, and I would like to thank each of today's participants for taking the time out of their very busy lives to share their insights with us. We host this forum to provide a platform for an in-depth discussion on how to solve problems, and the Kauffman Foundation does not take a political or legislative position on these discussions. So with that, I would like to turn our attention to our panel one moderator, Derek Oskell.
Thanks for joining us again today. It is my honor to introduce our first panel. We'll be introducing first Abigayle Davidson, Research Manager, Aspen Network of Development Entrepreneurs, the Aspen Institute, and Miss Victoria Hume, Research Analyst, Aspen Network of Development Entrepreneurs, or Andy. So without further ado, please take it away.
Hi, everybody. Thank you, Derek. Let me share my screen. I put together a PowerPoint. Thank you, everyone, for joining, and thanks, Derek, for the opportunity to share. We recently released a couple, I say recently, it was sort of back in May, but we released a couple of reports which are very much the capstone to the work that Galley's been doing over the past 5 years. So I'm excited to share what we've learned and sort of target our insights to different stakeholders that engage with accelerators. So before I jump in, though, I just wanted to introduce Vicki and myself in case we haven't met any of you. I'm Andy's research manager, and I'll give a quick overview of Andy. And Vicki works with us as a research analyst. So I'll be doing the presentation today, but Vicki will be jumping in with the during the panel discussion and Q&A as she's done a lot of work on this project as well. Yes, and somebody asked if we can have access to those reports. I'm sure in like a follow-up, or I think I have a link somewhere in the presentation. But just a quick on Andy, just so you know where we come from and why we're doing this research. Andy is the Aspen Network of Development Entrepreneurs. We're a network of organizations that support entrepreneurship in developing economies. So this ranges from investors, foundations, capacity development providers, a lot of accelerators and incubators, and we're all around the world. So Galley started in 2015, informally in 2013, as a partnership between Andy and Emory University. That's the Goizueta Business and Society Institute logo you see here, designed to gather evidence on the effectiveness of accelerator programs. Some of the other organizations you see here that came in to support us were funding accelerators or considering funding accelerators and wanted to have more information on whether they were actually effective or whether these success stories we were seeing coming out of accelerators would have happened anyway, even without the support of an accelerator program. So we partnered with Emory University, who had actually already begun collecting data from entrepreneurs when they apply to accelerators. They had a standardized questionnaire that they would embed into the application process of accelerators that asked, all of the basic, fundamentals of what's your business model, what sector are you working in, revenue, investment, et cetera. And from that, we've developed over the course of 8 years, developed a data set of over 23,000 unique ventures from around the world that applied to accelerators. And what's unique about this data set is we follow up annually with those founding teams, whether or not they were accepted into an accelerator program. So we have not only this data on 20,000 plus entrepreneurs, but then also we see what happens to them over time, even for the ones that are not accelerated. And just a couple other notes on what Galley does in case it's of interest to anyone here. We also collect completely separately data on accelerators based on their public, the information they put out publicly on their websites, just to have a directory, try to learn as much as we can about accelerators based on their public presence. So we have a directory where you can search for accelerators and also some descriptive statistics about them, like if they provide funding, how long the programs are, where they're based, et cetera. And we just consistently are trying to put out tools that are useful for accelerators and funders primarily to make sure that accelerators are aware of the best practices based on research, and funders are aware of all the ways that can be most supportive and understanding of all of the challenges and learnings going on within the acceleration world. And I wanted to note also that the data set is downloadable for free for research purposes. We've had a number of academic papers be published with the data. So we really encourage researchers to look into that if you're interested in checking it out. So some quick stats on the Galley data, which was really behind the research that I'm going to talk about today. Most of the accelerators that we partnered with are, if they're not specifically branded as impact accelerators, they're similar. So a lot of the ventures that participate have some sort of social or environmental mission. Most are very young, less than 3 years old. Common sectors being education, ag, health, ICT, and really they're from all over the world. We have especially good representation in Latin America, Sub-Saharan Africa, and the US, but we do have ventures from every region of the world. So how do we measure accelerator impact? This is a very challenging thing to do, which I'm sure everyone who's going to speak today can attest to. There's various ways you can go about it. You can look at what's happening to ventures that graduate from accelerators and see how they perform. You can talk to them about what role acceleration played in their experience. Then there's a number of other methodological approaches. The one that we took is we, like I said, collect data on the accelerated ventures and the ones that applied but were rejected. And we look at that difference in their growth over time to try to estimate the effect acceleration had on these businesses. Now, this is not perfect. This is not a control group for the researchers in the audience who run RCTs and whatnot, but we do think it's getting us closer to having a more conservative estimate of the impact of accelerators, because we need to acknowledge that even the entrepreneurs who are not going through accelerators are growing over time. So by comparing this, we can get a better estimate, and then combined with some other approaches, interviews and different ways that we work with the data, we can get a little more specific as well. So this is the backbone, though, of Galley's methodology when we talk about the impact of acceleration. So just to note, these are the two reports that were just put out in May, especially the one that's called Does Acceleration Work? I highly recommend, because it's a summary of everything we've learned from the Galley project over the past 5 years, and not just what we've published, but also pulling in the the academic papers and other studies that have been conducted with the Galley data. So if you're curious what's been done with the Galley project, what's been learned from the data, this is a very quick, I think it's like a 16 to 20 page read, and gives you all the information you need in a very short amount of time. So I highly recommend checking that out. So I broke down what we've learned in the past, these past 2 reports and really over these past 5 years into 4 key takeaways, just to keep it simple and share what we think is most useful broadly for the sector. So the first is that based on our methodology, acceleration works on average. And what we mean by that is that participating or accelerated ventures are outpacing the non-accelerated in terms of revenue and investment growth. So again, there's many mechanisms behind this. There could be different reasons, which I'll talk about in a minute. But on average, we are seeing businesses going through accelerators are performing better than those that are not. And here's just a screenshot from one of our studies, just showing total funds, which for us is revenue and investments, all the new funds that are coming in each year for ventures, and it gets that gap between accepted and rejected exists when at this time of selection, which we call application here, meaning the ventures that are accepted into a program are already performing better, not surprising, because accelerators try really hard to select the most promising businesses. But that gap continues to grow over time, which we think is a good sign. And on that topic of selection, a lot of people look at this and they say, okay, this is nice, but don't accelerators just select the best entrepreneurs? And that's really this impact you're catching. It's not actually, or that you're capturing, it's not actually the impact of the accelerator programming. And that's a very important question for our field, especially when you talk about where funds are allocated. And we take 2 stances on this. The first is to acknowledge that accelerators spend a considerable portion of their financial and human resources on selection. So it's not necessarily easy to select the most promising ventures. There's a lot of debate around what should you focus on. Is it the business idea? Is it the entrepreneurial team and their dynamics? There's a lot to think about. And accelerators spend a lot of time, putting together their selection panels and recruitment efforts and whatnot. So we want to make sure that that's not sort of explained away, because that is one of the offerings that accelerators, provide to the ecosystem. Is they, especially when you think about investors, like accelerators are the ones finding these ventures and then sort of putting the signal out to the field saying, these are the ventures that are worth looking at, worth supporting and investing and partnering with. So we always want to make that statement that selection alone, even if accelerators are only just selecting the best entrepreneurs, that alone is an impact in and of itself. But it is important to understand if there's an impact above and beyond that. So for this, I just took I copied and pasted this takeaway from a report that was published in World Development that used Galley data and was able to go a little more specific into the data set and take a more rigorous methodological approach to address this question of trying to separate out the programming effect versus the selection effect. And they did find that there was a program effect on equity investment raised above and beyond selection. And it's a little complicated the way that they did this, but for any researchers in the crowd who are interested, I highly recommend checking out this paper. It's very interesting the way they take advantage of, they do a matched sampling, like seeing who appeared to have a similar amount of promise as entrepreneurs when they applied. And then they also looked at the sort of time duration, time spent in an accelerator and how that affected equity being raised as opposed to just the accelerator acceptance being like a signal. So anyway, it's more complicated, but it was really interesting for us to see this be done with the data and to show that there is an effect above and beyond selection. And one more point on this first takeaway, we say acceleration works on average, and that's really important. Most of our analysis is done by taking the mean of, performance for accepted and then performance for rejected. But within that, there's a lot of variation, not just within the entrepreneurs themselves, but also within the programs. We saw that several a good portion of the programs actually that we studied, the rejected entrepreneurs actually outperformed the accepted entrepreneurs on average. So it's not the same across the board. But what is valuable with this, big sample of 20,000 entrepreneurs, as you can say, maybe you can't go so deep in the mechanisms, but you can say, hey, look, across the board, we're seeing something positive happening here, and that's a good signal for accelerators. So my second key takeaway is that most entrepreneurs that participate in accelerators are not experiencing significant growth. So it's easy to see those average numbers and, say it's like 40,000 more in revenue for accelerated ventures over rejected. That doesn't mean every entrepreneur is increasing their revenue by that margin above and beyond the rejected, right? It actually is capturing some entrepreneurs that are performing really well and some that are not really taking off at all. And this figures from one of those reports that we published in May, just breaking down like the top performers, the top 25% versus the rest. And obviously the top 25% perform better. That's how we calculated it. But the gap is pretty significant. And the lower performing ones really didn't see much change at all. So I'll come back to that when we get to the recommendations section, but I do think it's important for accelerators and particularly funders of accelerators to acknowledge that the process isn't necessarily meant to help everyone at the same rate or even everyone at all. In many cases, accelerators are trying to find, they're taking some risk, right? Some of the ventures may fail, but others may really take off. So third takeaway is we've been asked, time and again with such good reason, what is the best accelerator model? Because even though, so we had in the introduction, the accelerator, the definition of an accelerator was shared, which is, cohort-based, fixed term, selective and usually ends in a pitch day. Many thanks to Susan Cohen, who will speak later, for putting that definition in writing early on in the acceleration research field. But we've noticed that the term accelerator is being used very broadly, especially when Andy focuses on emerging markets. And as we look at developing economies, we see that while programs are wanting to have a similar effect as accelerators, sometimes they need to take a different approach. Oftentimes, because if the goal is investment, it takes much longer. That 3 to 6 month period is not enough. And oftentimes things will get a little more relaxed toward the end in terms of timeline, like some entrepreneurs stick on for longer and whatnot. Anyway, so there's a lot of different approaches to acceleration. Should you be sector specific? How should you format your curriculum, things like that. And we've tried using the Galley data to see if some programs perform better, have similar characteristics. And essentially, we did find a few things that were in common, but in general, with these fairly surface level variables, which we have, which is like, are you sector specific? How long is your program? Those descriptive characteristics, you really can't find much in terms of what makes the most effective program, which tells us, that there's no easy recipe for do X, Y, and Z, and you'll have a successful accelerator, but it really does depend on your context, on the types of entrepreneurs you're serving, and then on the harder to measure mechanisms by which you're helping entrepreneurs grow. So clear takeaway is if you come to us and say, what's the best model for an accelerator? We're going to say, we don't know. But we did learn some things in terms of the positive and negative factors. This is both through some of our analysis and a lot of interviews with entrepreneurs that had experienced success after acceleration. In some cases, they said it was due to the accelerator. In some cases, they said that the accelerator didn't do much for me and I was able to succeed regardless. So the positive factors that emerged were, accelerators that create an environment for peer learning. It seems that a lot of the programs that performed well in our data set did emphasize peer learning as a key component of their benefit. And when interviewing entrepreneurs, they almost always said that that was an unexpected benefit that they received from the program, but one of the most important ones. And that's because sometimes your peers become your partner, they may become an investor, they may become a customer, like, or even just the pressure that you feel needing to show the way that you're growing in front of your peers. There's a lot of benefits to the peer aspect, which is really inherent to the accelerator model. Also, customized support training does seem to be useful in getting entrepreneurs on the same page in terms of knowledge, but it was really the customized support that came out time and time again in terms of, we had this problem and the accelerator staff introduced us to the right people, gave us the right advisor, and we were able to work through it. Localization of services and clear expectations. Making sure that what your program is focusing on in terms of outcomes and what you're marketing is actually something that is achievable in your locale. So an example, which is in the negative factors, is of a experience an entrepreneur that I interviewed had, which was not good, was, joining somewhere in an emerging market. They joined an accelerator that was very much focused on investment readiness. And the accelerator, the way they marketed it was like, oh, you're going to get investment. We're going to have this demo day. It's going to be great. And they went through the program. And in the end, the whole time they're preparing for investment. And then at the end, they do a pitch day. And there's very few investors in the audience. The ones that are there are just there to be supportive or who are interested, but no one's actually there with any real intention of investing. And that's just kind of an example of, if you're going to have an investment focused program, have real interest from investors, or maybe focus it on growing more organically or finding ways to help boost revenue growth or grow your customer base, making sure that you are aware of what the ecosystem around you actually has to offer, and not thinking that as an accelerator, you can fill gaps that you might not be able to fill. And then I'll speed it up. I think I'm going slow, but the strategic introductions came out time and again as key, that usually that the accelerator staff were making for the entrepreneurs. And then the negative factors, lack of peer learning, as I mentioned, or cohort cohesion. It's hard to have good peer learning if you're with entrepreneurs that are at a completely different stage than you, are in a very different sector. And that's not to say sector-specific programs are always better, but just having enough similarity that the entrepreneurs feel they can learn from each other. Poor matching between entrepreneur needs and accelerator offerings. It appears that sometimes entrepreneurs get into a program not really understanding what the accelerator offers, and that can lead to entrepreneurs dropping out or just being dissatisfied. So, making sure that the communication about what the likely outcomes are is really clear. And then also, as I mentioned in that example of the dissatisfied entrepreneur, is that overemphasis on investment if there's not actually a lot of investment to be had. Some entrepreneurs that did have a good experience with acceleration, it was actually more about finding the right partners and learning how they should be expanding and how they shouldn't be expanding. There was a lot of other benefit that wasn't just the investment at the end. So fourth takeaway is that, acceleration, when we look at on average, we talk about these average numbers, but then there's all those questions about, okay, well, what about women-led ventures? What about ventures in developing economies versus, high-income countries? What are the gaps, and is acceleration closing those? Like, should we be looking to acceleration as like a gender equity tool in business internationally? Questions like that. And so we've tried to address those in some of our research. And I think our takeaway is that acceleration does have benefits for everybody, but not the same benefits, and it definitely doesn't level the playing field. So this is just one look at a analysis we did of high income country versus emerging market ventures. And while they all saw a boost, the gap, does not close through acceleration when it comes to investment. And in many cases, that's because of the ecosystems where these ventures are operating. And then also with gender, we looked at women-led teams, mixed gender teams, and then men-led teams. And women-led teams came into accelerators with less investment. They raised less investment during the process. And even when you account for control for several variables about their interest in investment, like how much they were planning on fundraising for and their sector, et cetera, there's still a clear gap. So I think our takeaway here is that, look, it's important to acknowledge that accelerators can't be the fixer of all the gaps in the ecosystem. And it's important to see them as part of the ecosystem, part of the puzzle for helping entrepreneurs achieve success and closing some of those equity gaps. So recommendations put together for accelerators, entrepreneurs, investors, and donors. I won't read every single one of these because I've touched on most of them, but for accelerators, we essentially just say, like, it is okay and important to actually make sure your program is really specific to your location. There may be outside pressure to sort of pick up the Silicon Valley model and then pop it down in an emerging market, but that's not realistic. So think about what actually makes the most sense. What are the resources you can draw on in your ecosystem, and how can you make success? What can success look like for your entrepreneurs realistically? And then also the piece about contributing to biases. There was a study with Galley data with the World Bank and Village Capital that found that, you know, many times in acceleration, the gender gap actually widens because there's already a gap coming in, but then the men founders seemed to really take off when it came to investment, and then the women didn't. So it's like the gap wasn't only not closed, it was widened. And our encouragement here is, well, there's not a lot of research so far on how to address biases within your work as an accelerator, but there is some that's coming out. Frontier Incubators was one that put out a guide on gender lens acceleration. There are some guides and resources emerging on how to address that. For entrepreneurs, we encourage a few things. One, be really picky, selective about what program you want to go into. Make sure that you actually see who's graduating from the program and that is the type of entrepreneur that you are seeking to be. And make sure you really understand what the accelerator is offering, because there's, especially now in certain ecosystems, like Nairobi comes to mind as an example. There's so many accelerator and incubator programs, it can be hard to choose. So take your time to figure out which one is actually the best fit for you, because they do vary quite a bit. And then also consider attending multiple programs. That's sort of a controversial piece of advice, because I think many accelerators have been frustrated with entrepreneurs that sort of recycle through these programs just to keep their business alive. But we did some research on this in a separate report, which I haven't touched on here, but it looked at entrepreneurs that attended programs that were fairly different at different stages in their business. It actually seemed to be really important for their growth. So if the accelerator is offering, for example, maybe you start at an example I think of is in talking with Mass Challenge Mexico. They had certain entrepreneurs go through, really take off, do great, and then they would end up at another accelerator in Silicon Valley and then just take off from there. So in some cases, it's actually really useful to go through more than one. And then for donors, policymakers, accelerators are effective on average, but so let me break that into 2 points. Accelerators are effective on average. Not every accelerator is effective. So it's important to understand what an accelerator can achieve in a particular ecosystem. If you're in an ecosystem that's constrained with investment, policy, the culture of entrepreneurship, maybe that's not the best place to have an accelerator, or if it is, just have very realistic expectations of what they can do and make sure you're funding other pieces of the ecosystem to come around and help as well. And don't assume that all the entrepreneurs that go through an accelerator will benefit equally. So we've seen some funders say, okay, I'm going to give this accelerator money and your outcome has to be that 80% of entrepreneurs grow by this much. That's fine if that's what the accelerator actually thinks can happen, and maybe it's moderate growth they want to see in a large number of entrepreneurs. But if they're wanting to see some entrepreneurs really take off, you need to consider that maybe it's a much smaller proportion that actually succeed, but maybe they succeed at a much higher level. And that there's no one size fits all program. So if as a funder, you funded a program in Malaysia that seemed to work excellently, don't come to Uganda and say, I saw this work, so I want to fund this exact program. Like, really pay attention to the differences in the local context, and trust your local staff to guide and adjust the programming as necessary. And then last, accelerators need financial support. I know funders are very interested in seeing accelerators become self-sustaining financially. And I think that's understandable, because we've seen so much success in accelerators in the US, and particularly Silicon Valley, with their investment model. But that is just not the case in emerging markets. So we, and probably in many places in the US that are not Silicon Valley. So it's important to understand that accelerators can be beneficial, even if they cannot become self-sustaining in the near term. And then investors, we found that there's a pretty clear disconnect between investors and accelerators when the accelerator is not acting as the investor. There's oftentimes this breakdown in terms of entrepreneurs, coming out of these programs, investors being in demo days and pitch days, but not being very serious about it. And then the conversation between the accelerator and the investor after the pitch day being, the investor saying they weren't really a good fit for me, and looking at how that communication should have started much earlier in the process. And that, actually working together, and the investor guiding the accelerator to actually what they're looking for and how to select entrepreneurs that they would be interested in investing in, really would make this process most efficient. I've been talking for a long time. I look forward to the Q&A and the discussion, but here are the links to the reports. All of our reports are at that first link, the accelerator directory, and that list of accelerators. If anyone's interested in doing any research with that data set, also talk to me. And then, downloading the entrepreneur data set, and you can find more information there. So I'll wrap it up with this slide.
Great. Thank you so much, Abby. I encourage everyone who's attending to please use the Q&A if you have questions that you'd like to learn more about. I have so many questions in my head, but it's great to get feedback from those attending as well too. So lots of places potentially to start, and I thought maybe I would start with a little bit from the data perspective about thinking through how accelerators maybe have changed over time and what they gather from their ventures, and especially as a result of engaging with so many different groups throughout this work. Are you seeing accelerators being more mindful about what they gather, both from applicants and from ventures that they've supported? Are there best practices or guides that you would recommend accelerators to think about as they collect information from would-be ventures that go through their programs?
Mm-hmm. Yeah, so let me make sure I understood your question. I think it was sort of split into two, like how I've seen accelerators adapt over time, and then also the information they collect from their entrepreneurs. Is that right?
Correct. Yeah.
Okay, good.
Forcing in multiple questions into one.
No, I don't want to answer a question that wasn't asked. So Vicky's done a lot of our work actually in workshops and presentations and whatnot with accelerators in person. So I want to make sure that she was here to share any insights she had. But yeah, the accelerator model. So we're gonna continue researching this topic in the coming years, and I really want our next focus to be on how this accelerator model is changing. And there's already research being done on this, which is excellent, but especially from and apologies, I know most of this audience is focused on the US, but in developing countries, that model is changing so much. And I think that does reflect a lot of what's happening in the US too, in terms of who is driving the accelerator. You look at a lot of Silicon Valley accelerators that were sort of driven by investors. But then now, especially in smaller communities in the US or in emerging markets, you see a lot of, most programs are funded by government or donors that want to see that same magic happen. So the incentives are a little different as well. They're not necessarily looking for, taking those big risks. They're wanting to build the ecosystem. So it's interesting, and it's made it to where the accelerator model, the name accelerator is really popular. The model is not always, what we think it is. And that question of how much of the magic of an accelerator is the cohort model and the fixed term and the investment, the pitch day is a really important question. Even when we were researching internationally, we had to drop the criteria of pitch day because we're like, more and more we see that being taken out, either with like an equity lens, because that's where a lot of like gender inequity can take place, or because it, the power, like if you followed any Village Capital research, they talk about flipping the power dynamic, taking the power away from the investors and giving it more to the entrepreneurs. So yeah, I'll just say the definition's become a lot more broad, and a lot more government donor driven. In terms of data collection, this is a very good question. So through Galley, we collected data, on the performance of entrepreneurs. It was kind of, in some ways, an outsourced M&E process. Like that's why the accelerators agreed to do this with us, is because they could outsource some of their evaluation. And we found that accelerators were collecting data on their entrepreneurs, but I would say the approaches were pretty rudimentary. There's a lot of mainly because of a lack of capacity. Like there's just usually not a specific person, a specific staff member in each accelerator that's working on M&E. So it ends up being like somebody who has a million other tasks who then also has to collect data and whatnot. So it's something that we've been thinking of ways to support accelerators. We've developed a training on data utilization and hoping to build capacity there. But there's also sometimes a disconnect in terms of what funders want accelerators to collect and then what accelerators actually find useful to collect. And that's, I think, something else that we encourage. I mean, I understand funders want to know the impact of these programs, but like the need to have these standardized metrics across your entire accelerator portfolio, I do think can cause some challenges for programs that are, if the programs you're supporting are different. So yeah, I'm not sure if that answers your question, but we do see accelerators becoming more sophisticated in their data collection and putting more emphasis on it than they were in the beginning. And again, I'm speaking primarily from the accelerators that are donor funded, where they actually need to report these metrics.
Thank you. And getting to some questions that are being answered in our Q&A, the data that's collected from Galley across the world. So that includes, I'm guessing, quite a range in terms of models of different accelerators. I know that there's industry-specific accelerators, and some don't have that at all. If I remember correctly, about half, I think, of the have no industry-specific focus.
Mm-hmm.
And I'm guessing there's as well too probably some accelerators that focus on just socially nonprofits versus for-profits, and just getting a sense for, are there other unique models out there that are emerging, or ones that, instead of equity models that are using, maybe look more like what traditional incubators would have done. I know that the definition is changing over time, but just thinking through some of these new models that might be emerging, or different types of accelerators that people might not be familiar with, if you've seen anything.
Yeah, for the most part, the Galley partnered with accelerators that some worked with nonprofits, most worked with for-profits, like just the sort of social venture, which is, meant to be profitable and have a social environmental return. That's essentially what we focused on. But I do know that there's a lot, basically just this concept of acceleration, like, can we get you from one point to the next in a quick way and with others, is just, I think, a very popular topic. So you might see accelerators emerging for nonprofits, but then you have to we have to talk about, like, what is the definition of an accelerator really? And when you say the word accelerate, it makes sense that term is being used across the board, but we haven't focused much on like nonprofit accelerators. But I will say, I I do think that the focus, at least for us, as we go broadly outside of the, the tech centers in America, like looking at revenue outcomes instead of just investment outcomes, I think is really important, because you get more of those ventures that are wanting to grow organically. And in some cases, that's because they're not wanting to, be acquired or see that exit right away, but they're just trying to build successful businesses.
A few more questions coming in from the audience. Please feel free to continue adding to that queue. One of which kind of addresses what you mentioned a little bit before in the presentation and alluded to a little bit there as well too, thinking about if you can elaborate a little more on some of the pitfalls or dangers of trying to copy just a Silicon Valley model in emerging market settings, or even different settings in the United States. Like why, can you tell us a little bit more about why that may not work? I think it probably relates a little bit to some of the takeaways you already mentioned about some of the common themes of where you see successes and where you don't. But I think there's just some appetite to learn more about why and why people might try that.
Yeah. I mean, I think that was the initial idea when we received our initial funding from a group of donors was, can we pick up this blueprint and put it in different places, this Silicon Valley blueprint. I would say the number one reason why that is not a good idea is just when you're starting accelerators with the goal of building an ecosystem rather than getting a return on your own investment as the accelerator/investor. The goals are different, and therefore the structure should be different. And the focus on investment is just unrealistic in a lot of places. Like, I mean, maybe if you want to see, ventures get some grant funding and have favorable loans and whatnot, that makes sense for building their business. But this equity investment focus outside of New York and Silicon Valley, it just becomes unrealistic. Vicki, I know you've interviewed a lot of entrepreneurs and accelerators too as part of this. I don't know if you have anything to add about the blueprint of the Silicon Valley model and why that doesn't necessarily make sense in a lot of places that we work.
Yeah, I think what you said about the ecosystem building goal versus kind of finding the next unicorn is sums it up the best. But I also think kind of reversing that, like the existing ecosystem in Silicon Valley and in the States generally, there are just a lot more availability of resources that are not necessarily as available in emerging markets. And so to kind of look for the next million or billion dollar idea, but not necessarily have you as easily as you could in the States is probably why it's not necessarily like you're not able to pick it up and drop it anywhere in the world.
Mm-hmm. Yeah, and actually, you're right. Like in general, in the States, it's easier. But I do think, even as we're talking, I'm thinking about how we could actually probably do some interesting work on, areas like some of the similarities we're seeing in like more resource deprived areas that might be similar in the US to, certain areas across the world too. There are more similarities, and we think we tend to bucket it as like US versus international because that's a lot of the work we do, but there's a lot of nuance there as well.
Thank you both. Another kind of related question from the audience, kind of curious to learn more about kind of that ecosystem approach. Like it's very clear that you can't put everything on accelerators to fix systemic inequities. But are there other ways or recommendations about others that collaborate or support or provide support services to accelerators? What should they be thinking about?
Yeah, it's a good question. So a few things. I think if you're putting an accelerator in a place that's very resource constrained and isn't necessarily already an entrepreneurial hub, then the impact you might be looking for and seeking to measure might be helping to build an entrepreneurial culture. So like even participants in your accelerator and their experience and what they go on to do, even if it's not that their business becomes very successful, I think is an impact if you have the long-term, change in mind. And I think there's also, I can't think of any examples off the top of my head, but I'm sure there are many funders who are coming in saying, I'm going to fund this accelerator and, try to form this partnership with the university to fund more, entrepreneurship programs within the school, and any way that there can be like more around the accelerator, I think the better. Or to say, like I talked to one entrepreneur who said, hey, I went through one program. They said they were focused on investment readiness. There were no serious investors involved. I went through this other program after that, and they actually told us from the beginning, you will all be competing for, I think it was like 1 to 3, grants of this amount of money. And then at least they went in knowing like, this is exactly what we have to offer. So that would be another way that, supporter of an accelerator could, say, okay, let's bring in entrepreneurs, not just think that training them is going to close their gaps, but actually have some resources to back it up, to see them to the next level. Vicki, you have anything to add?
Yeah, I think what you touched on, like supporting the broader ecosystem around the accelerator, like if you are trying to support an accelerator in their ability to support entrepreneurs, not necessarily just looking to train the accelerator and the trainers there, but also like looking to kind of bolster the broader ecosystem and reinvest in it, is probably a stronger way than to just kind of like throw money directly at the accelerator, or kind of just focus on the program itself, like having kind of a broader scope and seeing like what gaps exist, that filling those gaps would then better support the entrepreneurs going through the program.
I'll just add that we're also writing we're doing a lit review right now of research on building entrepreneurial ecosystems. And it does, come across really evident that ecosystems that are successful entrepreneurs themselves play a really key role in building the ecosystem, not just in being the entrepreneurs, but in reinvesting in other entrepreneurs, guiding the ecosystem. So I think that's something else for accelerator supporters to think about, is like, how are you engaging the successful entrepreneurs in the area where you're putting an accelerator? Can they play some serious roles in as advisors, as mentors, as leading the program, whatever? I think that's a key way to make sure the accelerator actually integrates into the ecosystem.
One question that comes to mind related to this is whether or not this is maybe the right way to have a framework for thinking about accelerators, in the sense of like they really do fulfill their word in both some positive and potentially negative or concerning ways. So one, like they accelerate the success, but they can also accelerate the inequities. Like you showed some pretty big differences in terms of like who may benefit from acceleration, and definitely some real concerns about gender and entrepreneurs of color maybe certainly not having the same outcomes. And then another thing that they accelerate too, that is potentially a good thing in one way, would be accelerating failures faster, so that people get feedback on their idea faster. So I guess just thinking through some of those mechanisms, like that they really do kind of speed up some of those things, both good and bad. What are some ways that the research can be done to better identify how to minimize the negative aspects, or or find ways for accelerators designs to be more inclusive, or the outcomes to be more equitable? That's a big messy question, because it gets through like all of the like support structures and the ecosystem around accelerators. But and if so maybe that's a big part of the answer, but just would love to hear some more about ways that can get to those more inclusive goals.
Yeah. So I'll take the first part about like failing, and then Vicki, maybe you can take the other part about like inequities. So for failing faster, I think what the other researchers on this call would say is that that is supposed to be one of the benefits of accelerators. So I think actually just making sure that that's seen as a benefit is good, because entrepreneurs, it's a waste of everyone's time and resources if they continue on in a business that's not going to make it. And so helping entrepreneurs see that and fail faster and see failure as an okay thing and that they can try again. It's really important. And we've been asked by many of the practitioners we work with, like, where's your research on what happens to the entrepreneurs, even if they don't continue on in this business? Does acceleration have an impact on their next business? And we unfortunately can't measure that, but I wish we could, because I can only assume that it would be helpful. So first, we need to see that as a benefit. That's one key part of it. Yeah, and then Vicki, do you want to speak to the inequities? That's a big question. And I'll note, I wish the Galley data set did collect like racial ethnic data. We don't, but I know there is other really interesting research on that. But we do have like gender, and then the other thing that we've looked at is whether the founders, especially as we look internationally, whether the founders are expats or locals, and where the, you know, if it's really just expats coming in and being successful, or if it's local entrepreneurs that understand their local challenges. Anyway, hand it off to you.
Yeah, we do have a report if anyone's interested on accelerating women-led startups on the Galley website. But I think, yeah, in addressing inequities, first thing that comes to mind is definitely just learning about the implicit bias within your own program, collecting that data and understanding like how your ventures are performing as an accelerator, and seeing kind of where that bias in terms of selection or representation is appearing would kind of be a first step in my mind. And then understanding that there are a lot of like kind of qualitative aspects that need to be taken into consideration, and there is no really quick easy fix. And so it's a lot of like listening and learning from the entrepreneurs themselves, and kind of a lot of iterations to address that. It's definitely kind of also a really much more like broader ecosystem and societal issue that I don't think necessarily accelerator programs are going to fix on their own. But obviously starting a conversation and showing that data and showing what gaps do exist and how they can be quantified, which I think our brief on accelerating women-led ventures does show. It's definitely a good starting point.
Yeah, and just one note on that, and then I know we're probably reaching the end of our time, but is we in the Accelerating Women-Led Ventures, just an interesting note is that we asked programs like, do you prioritize recruiting and selecting women-led ventures into your program? And then we like looked at the actual cohort makeup based on whether accelerators said they prioritize this, and there really was no difference. But the programs that had like a higher percentage of women on their selection committees, like did have a higher number of women in their cohorts. So I think that just tells you that like saying you want to focus on gender is very different than like taking actions to actually change the makeup of who's running the program. And one more note is like, I really want to do research on this. I haven't, but like, especially internationally, there's so much interest in running like women only programs. And there's a lot of debate on, does that help or does that exacerbate like the disconnect between women and the other successful entrepreneurs in the ecosystem that they need support from? So a lot of good questions that I hope the researchers on this call will take on regarding that.
Great, thank you both so much. And we are running up against the end of the hour, so we do have a few questions that we won't be able to get to live here, but maybe to kind of summarize some of the last steps here. One of these questions I think maybe gets at that, which is like kind of thinking about accelerators in the entrepreneurial ecosystem. Like to what degree and in what cases is it beneficial for accelerators to kind of take the lead or just be another resource provider? The question posits too as well that perhaps it just depends. But thinking through like some of the interactions of the way that accelerators connect with the other players, like you've talked about entrepreneurs, donors, policymakers, accelerators, mentioned universities earlier as well too. So just thinking through like, are there ways that we should be thinking about accelerators more holistically in context of everyone else?
I think accelerators are really good kind of so I'm looking for like temperature taker of the ecosystem. And so using them in that sense and kind of getting that type of feedback, because they are one-on-one with the entrepreneurs, but other kind of higher level actors might not be able to kind of interact with us directly. So I think in that sense, they're probably good. Abby.
Yeah, I like that takeaway. Good temperature check. Yeah, it depends. It definitely depends. And I would say that they can take a lead role, and that it depends a lot on how locally led they are, and whether it's successful entrepreneurs pushing forward, because in that case, I think there's a lot more room for them to lead rather than just be a support.
Great. Well, thank you, Abby and Victoria, so much again. Really appreciate it. I think that there's a tremendous amount that you were able to synthesize from having such a wide take on the field, and it's been impressive to see both kind of the takeaways and how they're different for different policymakers, and getting us closer to having some best practice and takeaways. And so we're going to dive deeper into this in our second panel. So it's my pleasure to turn it back over to Anya Pechenia.
Thank you, Derek, and thank you, panel one participants. This was really informative, and there was a lot of information that was very interesting. We're going to shift gears now. We're going to have 5 speakers in our second panel. The second panel is titled "The Role and Impact of Accelerators in the Entrepreneurial Ecosystem." And our first speaker is Bill Adamowski. He is the Executive Director of Innovation, Entrepreneurship, and Human-Centered Design at Drake University. Bill, the floor is yours.
Thanks, Anya. Can everyone hear me okay? Anya, can you just nod? Okay, perfect. So I'm, like Anya said, I'm the Executive Director for Entrepreneurship, Innovation, and Human-Centered Design at Drake University. For those that don't know, Drake University is located in Des Moines, Iowa. So if you don't know anything about Des Moines, a population about, our metro area is about 700,000 people. So please take the comments that I make in that kind of perspective. So, I mean, I think we've made a lot of positive kind of things, but realize it's in a population of 700,000. And I think part of the reason maybe that I was even invited to the panel is that, the kind of things that we did, we think you can do anywhere, right? If you can do it in Des Moines, if you can do it in Iowa, you can do it anywhere. I'm underselling our local community some, but please take it from that standpoint. I'd also like to start my comments by giving you a little bit background, because I think that'll actually put my comments more into perspective. So I started my career, just to give you an idea, on the corporate side. So I was a management consultant at Deloitte Consulting, and then I became like CIO at GMAC Financial Services, and I was Chief Technology Officer at Wells Fargo Home Mortgage. And then during the dot-com days, decided to become an entrepreneur. Created a .com company, grew it to over 40 million in annual revenue, ended up selling that. So a nice exit out of that. And then I ended up creating another company. Everyone's talking about global. So created a global company, raised money from one of the largest venture capital firms in the US by name of NEA, New Enterprise Associates, as well as a large group out of India, multi-billion-dollar conglomerate, grew that to over 200 million in annual revenue. And then actually moved from Iowa out to Silicon Valley. As a tech guy, I always wanted to be out in Silicon Valley and see what that was like. So my wife and I picked up, moved out there, joined, I actually created a couple startups, but joined one where I ran corporate development, and we did a successful IPO, traded on the New York Stock Exchange until a couple of years ago. And then moved back to Iowa here about 6 years ago and got into academia based on all the things I've learned in entrepreneurship. Decided to sort of impart that knowledge onto new generations as well as communities go. So a little background. So, and you'll see why that matters when I talk about these kind of things, because it's important to know that I guess I'm not a traditional academic by background. So I'm actually one of the ones that are actually doing the things, implementing accelerators, implementing entrepreneur ecosystems. And so the first question that I get asked a lot, so I thought I would bring it up today, is, can accelerators truly be economic development engines for like your local economy? Or as as the previous panel was talking about, they were talking about really building out the entrepreneur ecosystem, and how do we play a role into that, or do we even lead that? So I know you guys are looking for numbers and evidence-based kinds of things on this call, because I think that's more interesting than us giving you sort of theoretical data. So, based on, once again, where we come from, started a program, accelerator program, and in 4.5 years, from zero to in 4.5 years, okay, starting from nowhere, 114 startups have gone through our program. They've raised over $39.5 million in venture financing. Remember, we're in Iowa, okay? 2 exits who are now investors coming back. So that's a big part of the entrepreneur ecosystem, is bringing in, successful entrepreneurs, not only back, but even to the party. Other kinds of metrics, I think that, people might want to see. I mean, it's very rigorous, our program. And so it's a program that not everyone makes it. In fact, I mean, 20% of the people that come into the program drop out relatively early, okay? And I'm talking in the first several weeks, because they're just not there to build their business. And this is not about learning, even though they will learn a tremendous amount. This is about building businesses, okay? And so 20% drop out in the first couple weeks. The rest of them make it through. And 94% of the people who complete our program are actually still in business today, which is, substantially higher than the national average as far as that goes. 60% have raised some form of capital. So most of them raise, and that doesn't, and the number could be higher. We should eliminate the ones that don't need capital, that are, actually profitable, have customers and some of those kind of things. But 60% raise some form of capital. And for those people who like SBIR, which is, the Small Business Innovation Research kind of grants, 74% of what I call SBIR eligible companies, right? So these are ones that might actually be able to get one of those. 74% of them have actually received an SBIR award, so which is, once again, much higher than the national average. And once again, I want to qualify, this is in Iowa. If you can do it here, I think you can do that anywhere. Now, a lot of our investment capital, yes, they're from angel investors, a good chunk, as well as some grant money in there, and then also institutional capital. But as the previous panel was talking about, institutional capitals, we've had to go to the coast for a lot of that. So with connections out in Silicon Valley, as well as Boston, as well as Chicago and Kansas City. Well, actually, we should have a couple from Tennessee, actually. I don't know exactly why Tennessee, but evidently there's a couple of venture capital firms out there that like Iowa Ventures. I don't know why, but maybe we should do a little research on that one, but they've invested a couple. So that's the first thing. Second one is a question, is actually a recent initiative that I think hits on a very interesting topic that people ask: can accelerators make a difference for minority, immigrant, and other underrepresented groups in our entrepreneur ecosystem? And so we were fortunate enough to get a couple grants. And then so we're actually now pointing a lot of our programs towards that group and saying, okay, can we make a difference in that community? And so from the early stages of this initiative, I can say, truly our findings are absolutely we can make a difference. And I think we can make a considerable or huge difference in that market. And here's what we found so far. So I've gone out and looked at the entrepreneur ecosystem and say, who services that space? And in our local area, there's probably 5. I mean, there's at least 5, probably 8 to 10 organizations that help minority and immigrant entrepreneurs specifically maybe start businesses, so that they, startup boot camp kind of things, or business boot camp, or startup 101, some of those pieces. But one of the huge gaps that we found, and I found this quite interesting, is that there are zero programs aimed at minority and immigrant growth businesses, okay? And these are, and growth businesses is widely defined. So that what I mean by that is, yeah, there could be technical, scalable type of initiatives, but also people that have created successful businesses, but maybe want to take it to the next level and grow it. But there's not a lot of focus on that. And once again, love to hear some more researchers researching that. But I mean, the gut feels like the government and other people who spend money on stuff are looking to help minorities, but it's really trying to get them, get them gainfully employed, start up some of these kind of different kind of things. But once they're somewhat successful, there's really no programs to go help in terms of opening up a new location, expanding their location, launching products out of what they have in terms of, the value props that they've created. So what we're doing in that case is basically we're going out there and recruiting them to join our accelerator program. So just to give you a compare and contrast, we're not creating a Black-owned business accelerator. And once again, they talked about in the last panel, there's probably lots of debates on that kind of stuff. I mean, our view is we have a successful program. And then what we're really trying to do is cast a wider net, do a much more intentional in terms of recruiting to get qualified candidates in the space of minority and immigrant entrepreneurs to come into our accelerator, right? And then, I guess a question I get a lot is like, well, what types of companies are those? And it's like, it ranges. And we do have a broad definition. We've had to broaden the definition of what we're looking at as growth, but we're also looking just for growth, right? So like one of them in our current cohort is a telehealth company. It's focused on mental health specifically for Latinos, okay? And what they're doing is they're connecting up with actually different countries to actually provide some of those services. But you guys know mental health is a huge problem, but even in our minority community, especially, let's say Spanish-speaking communities, it's even larger because there aren't providers who provide that service, right? So that's one. So that's like a tech kind of oriented one. There's another one that's like a cash remittance or cash movement app between here and the United States, because there's a lot of people sending money over. So we've got those tech oriented ones, but we also have ones that sit there like the barber college. There's one that I met with yesterday that I'm trying to recruit for the next cohort. It's a barber college. We used to have one in the metro area, but that doesn't exist anymore. And it focuses on African-American hair types, right? And so the one that existed, I mean, they just happened to have the building that they were in is worth a lot more than their business. So they ended up selling the building and the business was fine. But this person wants to go create a new one, right? But yet doesn't have the connections into the communities in terms of investment community, doesn't know how to put together sort of the business proposition, but does know how to actually implement this business. So it varies in terms of the different kind of things. So maybe a year from now, maybe Kauffman will be kind enough to invite me in to say, okay, what are the actual results from some initiative there, and we'll see what happens there. The third piece that I just want to talk about is a lot of people ask about the content, because I think the content does differ between accelerator programs. So what are we doing? And I'm not saying ours is the best by any means. I'm not even saying our program is the best. I just know what we do, and I know how. I know it works, right? And so so for would-be entrepreneurs or even policymakers, when they're looking at it, you should look at your accelerator and say, what are the goals of the accelerator? What do you want to get out of there? What are truly that? Trying to find the right people to fund that, I think, is a big piece of it. Are you focused on a specific targeted, market, or is it a specialization? What stage are you, emphasizing? So in our case, we're looking at early stage startups, right? Growth companies. And in our program is very content driven. So there is a mentoring component to it, but there's a lot of content involved. For example, the first part is the lean startup methodology, made famous mostly by like the lean launchpad piece from Steve Blank out at Stanford. And so our things is really the value. How do you figure out truly your value proposition and who your target customers are, right? And then the second piece is what we call Fundraising Academy. So I don't care if you actually raise capital or not, but I want you to put together a compelling investor pitch deck. And what that piece is based on is actually a methodology that I create. I'm actually writing a book on it. So here's some self-promotion, I guess. Should be out by the end of the year, but it's called the Storytelling Investor Pitch. So it brings together best practices from companies like Sequoia Ventures and NEA and what they're looking for, but helps you actually tell a story through that, because that's one of the key elements that are missing in investor pitch decks, is that people don't realize that 70 to 80% of an actual sale is emotional, not rational. But our investor pitch decks are typically rational, right? And so it's a way to go do that. And then obviously, it's worked in our practice here. So that's kind of nice. And then the third piece of it is a venture mentoring service. We're a licensee of the MIT Venture Mentoring Service. So that's the third component of what we do. And then what they'll do is they'll go into the venture mentoring, we'll create a mentoring team that they go on. So our acceleration, programmatically, it's 3 months, but it actually lasts for a lot longer. We ask for a 1-year commitment as they go through the program.
All right, thank you, Bill, so much. We are going to move on to our next speaker, Dr. Susan Cohen, who is the Assistant Professor of Management at University of Georgia. Thank you.
Hi, everyone. Thank you so much for inviting me. I'm excited to be here, and I'm going to dive right in a little bit. Before I do a little bit of background about me, I'm an assistant professor at the University of Georgia. I've been studying accelerator programs for about a decade. I was one of the first researchers in this space. And so I'm going to give you a little bit of a high-level overview of research that's been published. There's a lot more coming down the pipe, of course. So as we've discussed previously, and I'm going to skip over some things that we've already covered in other presentations, but accelerators are fixed term cohort-based entrepreneurship programs. The key difference between them and say some other entrepreneurial training programs is that they focus on ventures versus on individuals. And so they aim to accelerate new venture development, often by providing mentorship or some other educational components like the ones that Bill was talking about. And they culminate in some sort of graduation events. And as Abby mentioned earlier, the time of demo days, especially with COVID, might be shifting towards other types of events, but there's usually something that marks the end of those 3 months or 4 months or up to 6 month periods. They can be sponsored by a whole host of different types of organizational sponsors, including investors, corporations, governments, universities, and others. So this is a little bit of research that was published in Research Policy. I thought this particular graph would be interesting to the folks here. So the question of, are different sponsors associated with different outcomes? And as Bill mentioned earlier, understanding the outcomes that are desired by the accelerator, and Abby also mentioned finding that match between what you're looking for as an entrepreneur and the outcomes that are being, the accelerator is gearing their programming to is really important. And so as we looked at our sample, we found that investor-backed accelerators are stronger at lead to a greater probability of raising money, increased amount of actual money raised at a higher valuation. Now note, this is correlational data, so we need to do some more research in order to make sure that this is a causal relationship, because these are just correlational relationships, meaning the more investor-based accelerators were correlated with more investment funding, but we don't know if that is actually causal. Other research with Ben Hallen and Chris Big, looking at do accelerators work, and this is published in Organization Science. We looked at accepted and almost accepted ventures into 4 different cohorts of accelerator programs in the United States. These were top programs. We were trying to find an effect, and so we looked to see where we would be most likely to see that effect. What we learned is that some cohorts improve some venture outcomes. And so in these 3 different bar charts here, we have whether or not the venture is still alive, whether or not it still survived at the time of our research, whether it increased the number of employees, and you can see only 2 of the 4 did, whether or not it improved the odds of fundraising. So we can see this blue cohort 2012B, they're all anonymous, increasing the likelihood of funding pretty substantially. So we do see variation both across and within programs, very consistent with what Abby told us earlier. I put this on a separate chart because, as you can see, web traffic is on a different scale. So going to one of these 2 different accelerators, 2012 B or C, was highly effective at improving web traffic. And so we did see variance both across accelerators and within accelerators, meaning different entrepreneurial ventures really do perform differently. And so it's important for an entrepreneur to be realistic about this, and also about funders to be realistic that you're funding a program, but any individual startup within that program still has a pretty high odds of failure, and the failure rates are still high even at really strong programs. So how do accelerators work? I conducted a qualitative study. This was actually my dissertation. I did field research at 8 different accelerator programs. Actually, it was 9, but one of them folded during the program. I conducted a bunch of interviews. I then analyzed that data at a very high level. What did I find? Ventures at some, but not all accelerators enjoyed greater sales, higher self-reported learning, and higher odds of being acquired after the program. These accelerators had 3 common practices that I'm going to touch on at a very high level due to the brevity of this presentation. And so I have heard these questions of, well, what are the practices that accelerators have that make a difference? One is concentrating consultations with others. These others were most often mentors, but it could also be customers or anything else. And this is something that deviates a little bit with Lean Startup, or adds a little bit to the Lean Startup methodology. the best accelerators and the best startups who went through these programs were really having between, let's say, 75 and 200 touch points within a couple of weeks. Time compressing these were really important because in the beginning, entrepreneurs were suffering from confirmation bias, where they were really hearing the interviews or the customer visits that echoed their theses louder than those that maybe conflicted with what they thought to be true. Only after the first dozen or so meetings with others, customers or mentors, did they start to realize that perhaps they were wrong. And then they started to actually learn, and that would motivate their learning. And so it did take quite a bit of interacting with others for them to let down their guard and let that new information in. The second is increasing transparency about peer ventures. And Abby talked about this earlier, and just that peer effect. Understanding how to make that peer effect come out and really fostering this disclosure. And so having entrepreneurs pitch to each other, having them work in close quarters, having them update each other is particularly effective here. And so really mitigating those concerns of intellectual property too. Once they learned more about each other, they realized they were much less competitive than they initially thought. And the third is standardizing activities. And this actually goes against some of the things we saw earlier. But the thesis is that each startup follows a similar developmental trajectory, even if they need different things. That's not to say that you don't provide a specific introduction or specific advice, but really pushing them through a quite similar program can help balance out those positives or negatives. This is my last slide. And so the wider these practices work in conjunction, they reduce the biases in decision-making, including recency and availability and confirmation biases. Also recalibrate confidence to motivate learning. So they help entrepreneurs figure out that even if they might be successful in the future, they probably only have the seed of an idea and they have a lot of work to do. Reevaluate previously made decisions, and then also generate way more decisions, alternatives in order to inform decisions. So that's all I have for today. Some accelerators work sometimes would be my keynote for you to remember. I now pass you off to Gary, my friend Gary Dushnitsky, who's joining us from London Business School. So I'm looking forward to hearing what Gary has to say. Thank you very much.
Hi, everyone. Can you hear me? Yes, great. So thank you so much. Thanks for the warm introductions, and Susan and Abby and Anya. Pleasure to be part of this conversation. I am a professor at London Business School, so I come to you from across the pond. I'll give a complementary perspective if you wish. I will not use any slides. In a way, what I want to do is I want to touch on two points. I will not present the data to you. I think between Susan Walks and some of the people who are present on this call, there's been a great set of analysis done on this topic. What I want to do is maybe point at two observations and some questions that I think we might want to touch on, whether we're researchers, accelerator operators, entrepreneurs, or policymakers. And so the first one is, or the 2 points I'll try to touch on is A, the diffusion of this practice, and B, the heterogeneity of this practice. And so Susan raised her hand and said that she's been studying accelerators for over a decade, which is pretty much around when Y Combinator's was set up and came to prominence. It's a very young phenomenon. And yet there are 300 accelerators covered by the Galley database. I myself, when I moved here to London, started mapping out the accelerator scene in London. There was one when I landed, Seed Camp. There are dozens operating right now. I'm doing work on accelerators in Israel, Startup Nation. Every place you throw a stone, you'll hit 2 accelerators, not just one. And so just the sheer diffusion of this practice, I think, is very telling. And we want to understand why is it that it actually proliferated as much? What is it about it? Arguably, it's teaching individuals how to be better entrepreneurs. Maybe business schools have been doing that for a while. What is it that makes it so prolific? Is it the limited time that is required from participants to actually be part of it? Is it the limited capital that is required to launch it, as opposed to maybe setting up a venture fund that might require millions and millions? Is it about the opportunities of getting in early on startups and so benefiting from the upside? But if that's the case, why do so many accelerators not take equity. I think there's a lot of interesting observations just to understand in terms of the proliferation of this phenomena, which leads me to the following observation. So as a person who's interested in innovative forms of financing entrepreneurs, I have another stream of research that looks at crowdfunding, also a phenomena that has emerged around the same period of time. And what I've done there is I've mapped the population of 800 crowdfunding platforms that are operating in Europe. And one question that comes to be, and in a way it was even touched on at the end of the previous panel, is, are we saturated? Are there too many accelerators? One recommendation we've heard before is actually you might want to even attend multiple accelerators, although I think a disclaimer was made that it's in different geographies. But are we saturated? And I'm not gonna give you an answer to that, but I think it's a fascinating question. It's one that I've, in the context of crowdfunding, I have some interesting insights on. You're welcome to visit my website. But how does that apply in the context of accelerators? And maybe a corollary question: what does competition looks like between accelerators? How do accelerators compete? And I think this is actually an interesting question. And so complementing the deep insights we have about the entrepreneurs who are undergoing a particular accelerator to understanding how do these hundreds of accelerators pitch against each other is a question that we want to have a better understanding of. The related question to those, and I think was nicely summarized in Susan's summary slide, is, do they work? And so a lot of the conversation that we've heard in the previous panel is about model fit and what particular models do we want to encourage. I think what Bill ended up with most recently in his conversation was experimenting with a new form that actually is targeted at scale-ups rather than maybe startups. And I think all of these are questions that we want to better understand in terms of the organizations of these accelerators, and they can inform both those who run accelerators as well as policymakers or other stakeholders that want to support them. Another observation that I think is quite important next to the diffusion of this practice is the heterogeneity. And again, we've seen some really fascinating stats on the fact that while Y Combinator is an investor-led accelerator, we now see a proliferation actually of corporate-based accelerators, government-based accelerators, university accelerators, and so on and so forth. We also see some accelerators focusing on particular sectors or particular gender or certain communities. One of the exciting things for me is that this energy around different types of accelerators means that we actually have a lot of experimentation in how do we support entrepreneurs? And so closer to home here, if you look at Entrepreneurs First, which is one of the most successful accelerators in London, they've actually innovated by presenting something that is a hybrid between a venture builder and a venture accelerator. And that has actually been working quite well. And for me, the second observation regarding heterogeneity of this is embrace the fact that accelerators themselves change. And as somebody who is based at university that changes very slowly, I think that there's a beauty to be said about the way that accelerators adapt and calibrate themselves. What that, however, means is that it poses a really important question for us. In an analysis that I've done on all the accelerators here in London, as well as a corollary analysis on all the accelerators in Israel, what we find is actually that the cohort from which you graduate matters as much, in fact, almost twice as much as which accelerator you graduate from. And so the variance decomposition analysis suggests that there's about 7 to 10% of the variance in success explained by cohort affiliation, only about 4 by the accelerator. And so surely if Y Combinator accepts you, you should probably say yes. But for the 299 other accelerators, what cohort you're part of is as important. And all you need to do is listen to everyone who spoke before me to understand that that's actually quite clear. If peer dynamics, if within accelerator experience what matters, and accelerators keeps innovating, then it actually is the case that it's not just which accelerator you were part of, but also what cohort you happen to graduate from. And that insight, I think, is one that we want to incorporate further into our analysis, which lends me to the last point I would like to make. In a world where there are these hundreds of accelerators out there, one might argue that entrepreneurs themselves can be very confused. Where should I go? And so if there's ever a need for both research and practice to come together and offer a roadmap or an opportunity for allowing entrepreneurs to better navigate their way forward. So thank you so much. I really appreciate the opportunity to be part of this panel, and over to you.
Thank you, Dr. Dushnitsky. This was really helpful and interesting remarks. I am going to pass the baton to Tina Peterson, who is the founder and manager of the T-Mobile Accelerator.
Hi, everybody. Thank you so much for having me here. So yeah, as she said, I am the founder and manager of the T-Mobile Accelerator. And just to give you a little background on myself and how we started the Accelerator, I actually come from an engineering background. I've been working in telecom for many, many years, probably 15 years prior to starting the Accelerator. But around fall of 2011, I started pitching this idea that would eventually evolve into what you see today as the T-Mobile Accelerator. After having worked in the community as sort of a grassroots organizer in the entrepreneurship community around Kansas City, and really recognizing a gap in who was coming out and who was interacting with the community and who was helping to build some of these innovations that were new and exciting, in my opinion, there was a lack of corporate engagement in this process. And so I had a big question about why that was and what could be done about it. And I had a belief that exposing and unlocking corporate resources into ecosystems and to entrepreneurs and innovators outside of our direct employee base was something that would be useful and would help businesses grow, including corporates, in their ability to serve their customers. And so that's sort of initially how it started. In 2012, we started really light exploratory kind of poking into the community and asking what did the community want. We really took an external focus on how we would serve the community versus how we would serve ourselves. And I think that's really important to the way we operate today. And then we began testing programs in 2013, but if anybody goes to do too much research, you'll really see we picked up the brand and made it official in 2014. And that's when we started our traditional based accelerator program, as well as other programs. So we do run other programs, including a mentor network, boot camps, and all internal innovation programs as well, but I'll focus on kind of what we're most known for, which is the traditional accelerator program. So what specifically, I kind of mentioned this already, but like unlocking corporate resources into the ecosystem is sort of the goal, I guess, in a lot of it. But for those listening, probably you can glean this pretty easily. As a young company, it's really often difficult to work with a large corporation, and for a lot of reasons. The first one is, how do you even make contact with a corporation? The reality is the front door for a young company, a small company to a large corporation can be really hard to find. And so creating programs where you can be focused in the way that you extend outreach And for these external companies to really understand how to engage with you is important in that process. And the accelerator is one avenue by which T-Mobile does that. Over the years, we've extended programming, which includes partner accelerators. We've recently launched an incubator program as well, which is complementary, I believe, to our accelerator programs. We've been able to link into testing resources and lab functionality at our corporation. But I think it's really that key piece of like trying to get into the front door. So we're trying everything we can to sort of give access and open access to our resources, to our experts, to our mentors, to give our founders insights into what it's like to work with us, how T-Mobile works, preparing them to make internal pitches, and do all of those things. So our learning tends to be very focused around that corporate access. I will just mention we have worked with other corporations in this process, so we also give exposure to our partners. We have run a white label program for other large corporations as well. So there's lots of ways inside of even just our short form program that our founders can work with us interactively. But why does T-Mobile want to do this? I think that's the most common question, is why do corporations get involved? So it's great that this is sort of like a service and a learning for the founders, but what's in it for the corporation? So the reality is a lot. So we also learn a lot. It's been, for me, a very long journey. I said 2011 was when I sort of started this journey, and I've definitely grown and learned a ton through this process. Our model has changed over time on how we interact, how we engage employees into the process, and where we give access, and the timing of that access as well. And so we learn what is going to make it easier for these external companies. We also learn about our own services and products. As a carrier, trying to understand how people are going to use our services, how new technologies are going to leverage our networks is really important to us. Some of you may have heard our 5G messaging. Now we have the largest 5G network with the largest, fastest network, right? Well, what does that mean? Like, how are people going to leverage that? What do we need to know as a carrier in order to really provide the best services? And then on top of that, what other services can we offer to our customers to give them great experiences? And that's what's in it for us. And then I think the last thing that I want to point out too is that, as you know, we're a large company. There's a lot to be learned from founders just in general. I think maybe a couple of people have mentioned this, but maybe universities move slow, but corporations also move slow. So what do we learn from our founders? How to be nimble, how to be fast, how to change our mindset, and how do we match that pattern in order to do what we need to do to actually really push the technology envelope and make sure that we're bringing the best to the market. So I'll just kind of leave it there. I don't have a ton of research for you guys. We do have numbers on our cohorts, and so I'll just shout them out real quick. We've worked with 75 companies who have raised over $96 million in funding, and we have a little better than 80% success rate at the moment. So.
Excellent. Thank you so much, Tina. Really appreciate your presentation. And our next speaker is Heather Spalding. She is the CEO and founder of Cambrian.
Yes, thank you, Cambrian. Okay, well, my background's in neuroscience research, so I'm kind of a research analytical brain. So it's cool hearing all the research and stats from you guys about success of accelerators. So I was in 2 programs that I guess I didn't consider accelerators at the time, but they are. The first one that I was in 2017 was called Scale Up Kansas City. And you have to be in your business full-time, have existed for at least 2 years, have at least 200,000 in revenue. So these are really for businesses that are established but looking to scale. The great thing about this particular one is that all of these businesses were in the same boat. And just a little bit of my background, like I said, I was in neuroscience research. I wanted to get into bioengineering. I met my co-founder, who's an engineer, also wanted to get into biomechanical engineering. And we found computer vision as a really great meeting of our two interests. And we ended up applying it to home spaces and applying paint on walls. So finding where the walls are and uploading a photo and being able to change your paint color. We released our app and it was kind of an overnight success. So I really don't come from a business background in particular. And what I found in Scale Up is a lot of the people in that program had never been to business school. I mean, we know to pick up books and stuff here and there, but I didn't even consider myself an entrepreneur at the time. I just happened to be running a business. So you meet these people, and some of the people, I'll just say now, were maybe they started a restaurant and they wanted to scale by bottling their juices. And Ruby Jean's Juicery, he was in my cohort, just started giving his healthy juices for free to the local Casey area schools, which is just so cool. So, I mean, that was one of the things he was working on in my cohort, was how to get this up and running. And so this for us was like a crash course. I forgot to start my timer. A crash course in running a business. So we would have a week dedicated to marketing and analyzing our data and traffic and the importance of that. And how do we measure our successes? How are we tracking this? And how in our accounting, how are we breaking it down so we know that maybe the license is paying for the business and the service work we're doing is actually a detriment to us. And we didn't know that because we never broke it out. So it was very, very helpful, like a crash course in running a business. And again, to what I think it was Gary that mentioned how important the cohort is. The interesting thing I learned from this was it doesn't matter. Someone owned a jewelry store and they were looking to franchise, somebody, running a restaurant truck and stuff. It all came down to the same basic issues. How do we delegate? How I hired the wrong person, how do I onboard the right people? How do I set up processes? One of the biggest things I got from Scale Up is constantly be identifying bottlenecks in your business and turn them into easy, repeatable processes. Eliminate the bottlenecks. And this is how you scale. And this is, I still to this day, I tell my team, why is this slowing us down? We've dealt with this before. How do we overcome this bottleneck? So it was an enormously helpful program for me. You do network and you do meet a lot of people, and that's always helpful, but really just having the crash course with other serious businesses. These aren't people with an idea that just wanted to start something. These were people running a business that didn't have the business expertise and needed that crash course. And one of the biggest things for us too, with that particular program, I think a lot of us didn't know the importance of taking time to step back and work on the business instead of in the business. So taking a step back, and instead of emailing client, we turn off our phones, turn off our email, and for 4 or 5 hours, we do a SWOT of what our concerns are, where are the problems, and getting feedback from other people who have had experience with something you're struggling with. So that was enormously beneficial. The other program I did was Pipeline. And Pipeline, again, is you have to kind of be vetted ahead of time. You have to have existed for a while. You have to make so much in revenue in order to get in. This was a 1-year program. And once you're in it for a year, you graduate, but it had sessions. So like 4-day sessions, like 4 or 5 times a year. From day one, we were put through the gauntlet. You have brilliant entrepreneurs, sometimes serial entrepreneurs. They've bought and sold companies, or they've started and sold companies. They've failed in companies. And so when you're saying, this is my business, this is who I sell it to, this is how I make money, you have these other brilliant minds there in your cohort saying, well, did you think about this? Did you think about that? And kind of tearing it apart, which, like you said, failing faster is great. You know, you're learning something, it's valuable. So, so we kind of put each other through the gauntlet, and then we're kind of narrowing down. I'm not all these things. I really am just this thing. That is my bread and butter. That's my expertise. My class was 2019, and we have stayed so close. We're getting together tonight for drinks and dinner. So we are always staying in touch. We're celebrating each other's wins. We're commiserating. Everybody's always trying to hire, especially in tech. And so sometimes they ask me, just because our company is very high tech, you know, to help them vet new employees, you know, they don't know what questions to ask and stuff. So a lot of it is the community and the cohort as much as anything. One of the things I love that Pipeline focuses on is the entrepreneur's mental resilience. So I think entrepreneurs sometimes have a different brain than the rest of the world. You know, from one week to the next, you could be real high and get a $500,000 deal, and then the next week you're being sued. You know, you have to be able to kind of float on those waves. And one of the things Pipeline really focuses on was your health and well-being. You know, are you eating well? Are you sleeping well? Are you meditating? How do we build resilience so we're not our business? If the business fails, we're not the failure. You know, so on and so forth. So I don't want to take too much time. I do think corporate engagement and these particular accelerators would have been great. It would be cool to see corporate engagement reach across to multiple accelerators. That would be really beneficial. I know they did somewhat for us, but I would like to see more of that because I think that would benefit everybody. And then really quick, just because I have so many movers and shakers and influencers on this call, I wanted to point out that one of the things I always hear as an issue for small businesses my size is healthcare costs. If there was a way to vet companies, you know, we've been around for a couple of years, we're established, we didn't just start this up to get good healthcare prices, but that's one of the things I've seen close companies is that they can no longer afford healthcare. And for me, to cover my family, I have to pay $2,000 a month. I would really much rather be spending that money hiring another developer or something. So for small businesses, it is crippling to the point of having to shut down your business. And with accelerators, there has to be a way to vet these companies, they're legitimate, and maybe bundle us small startups together for an affordable healthcare package. And if it doesn't exist, my mind tells me I need to build it, but maybe you guys can help me.
Excellent. Thank you, Heather, so much for your presentation and for all the comments from all the speakers today. Right now, we're going to shift gears and go into the Q&A. So I encourage all the participants that are or attendees to drop their questions into the Q&A box so that we can get them answered for you. And the one question that I personally was curious about, it came through in the last panel, but it's kind of hanging there and it seems to be very applicable. The person is asking, I heard that a lot of accelerators end up stealing intellectual property and not actually giving out money. Have you seen examples of this going on in the field? And how does a person avoid those agencies? Have you heard of any of these examples? Is that a concern? And if so, how can this be mitigated? And
I can jump in, not because I have any information about Accelerator stealing ideas, but because in one of the hats I've been wearing is actually looking at corporate venture capital. So these are venture capital arms led by large corporations. And I'm sure that there are people here with lots of knowledge on this topic. One of the things that I have seen, question that I've been asked, I hate to admit, but over 20 years ago is exactly that question. If during due diligence, I'm being asked to disclose my technology, am I disclosing it to somebody who has 100 engineers that can immediately execute on it? And the short answer is yes, that's what you're doing. But that's actually no different than disclosing it to a VC that has 3 portfolio companies that between them have 100 engineers doing what you're doing. And so I think it's useful to situate it in that respect. The other thing that became very clear to me in that setting is that you need to do your due diligence on your investors. And so if this is a person who's leading a deal for the first time and has no experience in it, maybe they are less knowledgeable about how to manage this situation. If it is a person that have already led a few deals, is part of a team that has worked with several entrepreneurs, then these concerns are things that at the very least you can reference and understand. So these are insights I've seen in the world of corporate venture capital. I suspect some of them will be applicable in the world of accelerators.
Yeah, absolutely. I'll just build on that a little bit. I would say 2 things. First of all, accelerators are exposed to lots and lots of ideas. So one is you never know whether or not they really did steal your intellectual property. What I see from reading business plans and pitches is there are trends. And so you end up seeing the same idea over and over and over again. But the second thing is this is why ideas are not really valuable. So what's valuable is implementing them. And so I'm working with really reputable accelerator partners who, as Gary mentioned, where maybe speak to some of the graduates of the program. I run something called the Seed Accelerator Ranking, which we haven't done recently, so it's a little bit out of date, but trying to get your data straight on what the accelerator has done in the past, and then accelerate, right? You really implement and grow that business, and so that you have some sort of defense, whether or not that's filing for a patent or growing a market or taking up a piece of the distribution or supply channel or something that you're going to be able to defend long-term, because if you're successful at all, you're going to have competition at some point.
Bill, were you going to say something?
Yeah, but Susan stole most of that thunder. So no, I mean, I agree with Susan's comment as well as Gary's. I mean, one thing I would say is that if you do have true intellectual property, treat them more like, I mean, some of those trade secrets. So when you're actually talking to a potential investor, talking to an accelerator, you can tell them what you do, but don't tell them sort of the secrets, which is how you do it. So if there is truly something that you're going to file from an IP perspective, nothing says you have to disclose that. But if I'm talking to Susan, I need to make sure she understands the problem I'm solving and what my solution is to solve that. Now, if she sits there and says she wants to know the secret sauce, then you could start deciding whether, do the other investigation that Gary's talking about in terms of what that organization is like. But that's how we counsel people, because the key is if you don't go out there and if you're afraid because people are going to steal your IP, you're never going to be successful, right? That's one of the cool things about software, if you look at it, right, is that anybody can steal it at any time. And so therefore, the answer is you just got to move faster than everybody and you got to go deliver, right? Because there is no IP around software unless it's connected to some device and some other kinds of things, right? And so I'm sure Tina would disagree in some respect, but I mean, basically that's why the software world moves so quickly, is because we don't think about intellectual property and protection. We think about moving and trying to create successful businesses.
Excellent. Thank you. So another question that came in from the audience is actually around COVID, and the person is asking, do you have any insights on how COVID affected the social capital of entrepreneurs in accelerators versus entrepreneurs not in accelerators? Do you have any examples of how accelerators adapted to the pandemic to facilitate peer learning and networking?
Pipeline went virtual for a while. And they did, Zoom meetings all day and stuff. So Melissa Vincent took over as CEO of Pipeline, so she changed things anyway. But it has to hurt, I would think. I mean, there's so much of our bonding with our class was, staying in the same location, staying up, at night, drinking tea and discussing businesses and questions and stuff that you don't get when you're not in person. What they did is just had a lot more opportunities for meetings. So instead of meeting, 4 times a year and having it be intense, we have meetings, every week or every other week for something. I think it's just a difficult time.
I mean, I make like two maybe positive comments real quick. It doesn't really address social capital, but I mean, we have seen an increase in number of entrepreneurs that are sort of popping up. Primarily, I mean, once again, you got real researchers online. You just have Bill that has this gut feeling, but the gut feeling is that people had time to reflect. We're staying at home, doing different kind of things and saying, what do I really want to do? And so we're starting to see a lot more entrepreneurs from the aspect. So that's kind of interesting. And from an investor perspective, specifically angel investors, they seem to be much more interested in at least, minority and immigrant and other types of things, because maybe they took because remember at the beginning of the pandemic, we were also talking about racial injustice and some of those kind of pieces. And I think they did some self-reflection and then have reached out and said, we'd like to make a difference out there. So that's probably true with environmental and other social causes as well. We haven't seen that part yet, but I'm pretty sure from a gut feeling. So we did see, because people were in a different environment, that they did have some positive consequences as well.
Yeah, I think also removing some of the geographic boundaries has provided some more flexibility, both for some people who may not otherwise be able to, say, move for an accelerator program, and then also for mentors. So I mentor in some programs and I have seen more geographic diversity in the mentors.
Yeah, I'll just echo that. We were actually able to get access to even more executives and mentors through our program, just because, trying to fly them to one location and work with their schedules was difficult. So there's a lot of aspects to virtual programming that we will definitely keep going forward. But we do miss the in-person demo days, the being able to get hands-on touching and, holding and playing with the technology and the products. Those things we definitely want to bring back. And the casual social encounters are definitely have suffered those connections a little bit. You try and do it virtually, but it's just never, I don't think it ever quite matches up in the same way.
Having the discipline to, turn off your phone and really focus, and you get what you put in to all these accelerators. So when you're there in person and you don't physically have your objects and you're all sitting there focused, it's maybe easier. So maybe it takes a little bit more self-discipline on the entrepreneur's part.
Excellent. So we have very few minutes left, but I just wanted to ask a really broad general question, maybe popcorn a little bit across the speakers. Given that we are still learning about the value and effectiveness of the accelerators and all the information that you shared today, what would you suggest might be fruitful areas of focus for researchers to explore and then communicate out back to the community?
Bill, do you want to start ahead? What would be useful for you to run the most effective next cohort?
I mean, for me, well, if you're really just, if I answer Gary's question in that respect, it would be listening to different types of programming that people offer and how they structure it. Like, Susan talked about, meeting with a bunch of mentors right at the beginning, right? So like Techstars does some of that. So, we've seen some of those kind of things. What other people are doing in those regards. The other piece is, and you guys all hit it in terms of the cohort piece and the selection piece, because I spend a lot of time, quote, recruiting, right, to try to get the right cohort, not just taking the applications that are in and looking at diversity, not just diversity in, basically skin color and gender, but really in personality types to make a cohort, right? And love to see more on terms of that, right? So when Gary talked about, cohort makes a difference, it's like, I agree with you 100%, but I don't know exactly, like, am I doing the right things to do that? I think I'm doing some cool things around that, right? But I'd love to see some more data supporting that. And it's not super quantifiable. Maybe it's more qualitative, but you'd love to get some more quantitative aspects into that. Thanks for putting me on the spot, Gary. Appreciate that. No, I'm just kidding.
Susan, do you want to go next?
I'm working on all my really good ideas. I'd love to hear from Tina and really the people who are in the field. What would be most helpful? What could Gary and I and other researchers on the call, what could we do that would provide the most value?
So from my perspective, I don't know that there's a ton of research, and maybe I just haven't landed on it, but specifically to corporate accelerators and how they may be differing from this more venture-based accelerator models. I do think there's quite a bit of difference in how we operate, but what does that actually mean to a founder? I'm not sure that I've seen that, although I've given a lot of researchers interviews and time, and so I haven't seen the results quite produce themselves yet. And then I think, you know, to Bill's point, the selection is really interesting to me, like trying to understand what makes good selection criteria. How do you recruit effectively? How do founders select us, right? Like, so we're very lucky in that our accelerator carries a pretty recognizable brand. So founders can find us. But what does that mean to them? I think that we outline for them what we can give them, but like, how does that make for effective selection for the founder themselves? So that piece, you know, how can we assist them more, I guess, is selfishly.
I can jump in as well, and I fully echo everything you said earlier. One of the things that would be fascinating to me is part of the reason Accelerator happened was against the backdrop of a dramatic drop in the cost of starting. AWS and many other tools actually enabled you to do something meaningful in a 3 months period. And that opened the floodgate for this organization form. I would love to understand what does new changes to the way entrepreneurs run. For example, something that interests me is the use of low code, no code tools and how it opens the gate for non-technical founders to go ahead. And what might be the accelerator equivalent tools of the future? What are the exciting structures that can be put in place for us to be able to unleash that pool of talent? So these are some of the questions that would be of interest to me.
Excellent. I thank all of the participants today. We are at time. I wanted to take a moment to share our next forum for September 23rd. The topic is diversifying the entrepreneurship research pipeline, emerging learnings from 2020 Knowledge Challenge grantees. The registration link and link to our recorded forums are going to be in the chat, so you can click on those if you're interested. We're also going to be sharing more information about the upcoming forum and other events in our Insights to Entrepreneurship newsletter, and you can find the link to where you can sign up in the chat as well. So we hope you join us for the future events, and thank you all again, and have a wonderful rest of your day.